Good evening. Thank you for taking the time to be here. We have been engaged to audit the financial statements of Target Corporation, hereafter referred to as the company, for the fiscal year ended February 2nd, 2019. On the agenda today is a discussion of the information we have deemed relevant to potential risk of material misstatement in the audit, as well as the planned audit procedures to reduce those risks. So just as a short overview, the company is a general retailer offering a wide variety of products at discounted prices. They currently have stores in all 50 states with a total of 1,844 stores, which drives 92.9% of sales. The other 7.1 is attributable to their digital channels. Some interesting things to note are that they recently acquired their wholly owned subsidiaries, Shipped Inc., to aid with same-day delivery services, and they have increased investments to a historical high in store remodeling projects. So there are various financial statement level risks that the company presents. First, the company is public, so there are pressures to meet third-party benchmarks, which poses risk for material misstatement. Also, the retail industry is highly competitive with companies such as Amazon, Costco, and Walmart making up their peer group. Again, this creates risk for material misstatement to meet industry standards. Additionally, effective November 1st, 2019, Kathy R. Smith stepped down as Chief Financial Officer and it was replaced by Michael Fidelki, which could possibly represent a risk for weakened internal controls. Moreover, some other things that should be considered are the new revenue recognition rules under ASC 606, the U.S.'s trade wars with China and its effects on relevant tariffs, and management's recent concerns about the possibility of having to increase prices, which weakens their competitive advantage. And now Lacey will talk more about the steps we took to determine significant accounts.
Thanks, Jen. So to start off with Section 3, which is calculating materiality and tolerable misstatement, we chose the account earnings from continuing operations before taxes. We chose this account because it excludes discontinued operations, such as the Canada segment, which was discontinued in January of 2015, and it also does not include the taxes, which varied a lot due to the Tax Cuts and Jobs Act, which came into effect in December of 2017. We also chose an overall materiality percentage of 5%. We chose 5% since it's in the middle, since the company has not had any previous issues. However, they are expanding, so we don't want to be too lenient with them. This accounts to $183.8 million. This can also be found more on work paper 1010.1. We also chose a blanket of 50% of tolerable misstatement for all the accounts that were chosen. A total list of these can also be seen on work paper 1010.1. However, since a few deviated from this 50% blanket tolerable misstatement, I want to note them now. For cash and cash equivalents, we chose 75% tolerable misstatement since it's frequently dealt with in the company's industry, as well as it is easily audited, and we would like to have the assurance that the account is correct. Additionally, for inventory, we chose a lower amount of 25% tolerable misstatement due to the high volumes of activity, and since the industry is merchandising. Additionally, for buildings and improvements, 25% was chosen again due to multiple improvements of their buildings, and judgment is necessary in this area. Additionally, depreciation and amortization was chosen as 25% since judgment is necessary and there's the risk of understating this account. Additionally, equity was chosen to be 75% since it's an easily traceable account and has a large effect on the financial statements, and it is an account that stockholders and stakeholders of the company care much about. As for cost of goods sold, we chose 25% since once again the company is merchandising and there's judgment to be made in this account. As for SG&A, 25% was chosen once again due to the judgment aspect of the account, and litigation is included, which once again has that judgment effect. Moving on to Section 4, which is identifying significant accounts and disclosures. We started by doing a horizontal flux analysis as well as a vertical common sized analysis. For our accounts, we didn't choose a blanket percentage, and instead we used our judgment based on the percentages that were found from the analyses, as well as the volume of the usage of the accounts. As for the qualitative information, we used the footnotes that were documented in the 10K as well as the 10Q. In order to see the horizontal flux analysis and the vertical common size analysis, please see work paper 1010.2 for the balance sheet and 1010.3 for the income statement. Moving on to section 5, Jen will be back.
And now I'll give a short summarization of our horizontal flux analysis as well as our vertical common size analysis, which can be found again on work papers 1010.2 and 1010.3 respectively. For the horizontal flux analysis, it seemed that most accounts were fluctuating in the mid to low single digits, and so only accounts that fluctuated in the double digits raised concern for us. Some examples of these accounts are cash and cash equivalents and discontinued operations. However, the latter is not especially surprising as Target has been divesting from various business arms such as their pharmacy business and their Canadian operations. For the vertical common size analysis, we focused on accounts that represented a significant portion of their respective totals. In the balance statement, those accounts were building and improvements, as well as property and equipment, which were 71% and 62% respectively of total assets, which makes sense because as mentioned previously, the company has been increasing investment in store remodeling projects. In the income statement, cost of goods sold was also a significant account, but this is to be expected as the company is a retail firm. Though some anomalies were correlative with qualitative information, these accounts will still require prudent analysis during the audit process. And now I'll pass it on to Sean.
Thank you, Jen. With that flux analysis in mind, combined with other industry and company trends, we then underwent a fraud brainstorming session. Looking through the lens of the fraud pyramid, we first started by identifying the pressures and incentives to commit fraud that are currently placed upon management. A key variable we see contributing to this pressure is the retail industry's continued movement into an online-dominated space. Common knowledge would expect traditional retailers like the company to continue to lose market share and thus revenue to decline as well. Here, executives may feel pressure to silence any doubters or lack of confidence in their ability to adapt through manipulating of reporting. Furthermore, the recent appointment of a new CFO may also add pressure to immediately exceed third-party expectations on performance. After all, the new CFO compensation agreement has a heavy stock bonus structure of 100% of the CFO salary. In order to mitigate this fraud pressure, we will have to get a copy of all new management compensation contracts related to this new appointment. In regards to the opportunity to commit fraud, we see a few openings in the accounts that require a lot of valuations in the reporting that we briefly spoke about before. The accounts again are inventory, accounts receivable, and their allowance for doubtful accounts, depreciation and amortization expense, and all accounts related to construction of new stores and the remodeling of existing stores. For inventory and accounts receivable, we will have to perform our own evaluations on these accounts and compare them with the reported numbers. This will include tracking inventory and the turnover ratio, and an analysis of the aging of receivables. For depreciation and amortization, we will make sure that their schedules are in accordance with US GAAP. And for the construction accounts, we will bring in outside experts to make sure that the construction in progress are correctly classified. The ability to rationalize any fraudulent reportings would most likely come from the fact that they employ 360,000 people. In addition, they also see their purpose as a retailer is to try and help out young families by providing cheap goods. So that is also an easy way to rationalize any inclination to commit fraud. Moving beyond our discussion on fraud, we then utilized all the info gathered from the analytical procedures and our thresholds that we set for tolerable misstatement to identify 13 accounts that we recommend for the preliminary assessment. Within these 13 accounts, we marked which management assertions they should be assessed through. The accounts that require complex valuations, we gave the mark of high risk of material misstatement and set a low threshold for the amount of audit risk that we were willing to undertake. These accounts again are inventory, building and improvements, depreciation and amortization expense, cost of sales, and selling general and administrative expenses.
Thank you, Sean. Out of the above-mentioned accounts, we are focusing on 5 areas we found relatively risky. The first of these areas pertains to the inventory valuation method. We understand that their less than 3-month turnover ratio mitigates risk of obsolescence from certain external factors, such as changing economic conditions. But given the seasonal variability in the inventory valuation, With respect to peak seasons, we are aiming to test the through point time from the point of arrival to the distribution center to the point of sale at one of their stores. Using data analytics and corroborated information, we will then be able to confirm the asserted turnover ratio and stated risk of obsolescence. Finally, we will be confirming the physical existence of inventory at the actual distribution centers and stores for a representative sample size. This brings me to the next area of focus, the valuation of assets within the buildings and improvements accounts. We understand the complexity exercises a high degree of judgment for the impairment of assets. Our concern is the possibility that these impairments are not being logged in a time-appropriate manner. Therefore, we consult a valuation expert to confirm a representative sample size of assets within this account are correctly stated. Similar to the above-mentioned area, we will also be looking into the valuations for depreciation and amortization. Since they have a number of construction in progress going on, it requires a high degree of subjectivity as to when these projects are allocated to the respective PP&E accounts and consequently depreciated. There are also various other factors that are left to management's discretion, such as impairment, estimated lives, and the type of depreciation schedule. To reassure that there is no material misstatement, we will perform the depreciation and amortization calculations ourselves using a relatively conservative estimated lives that are within the stated ranges within the company's 10K. We'll also consult experts on the assets that are being depreciated to better understand when an asset should be impaired and their estimated useful lives. Moving into the fourth account, we will be auditing a representative sample size for classification and completeness within the cost of sales account. This particular account has a direct impact on the earnings and exposed to frequencies in freight expenses, markdowns, and rising tariffs. Therefore, we will assign an experienced auditor to verify all cost of sales are reflected within the appropriate reporting period and fully realized. Finally, we will look into the SG&A account. Similar to the cost of sales account, this account has a direct impact on earnings. For this particular account, we will use data analytics to project the allowance for bad debt expense related to third-party bank-issued cards compared to historical records. We will also consult an expert in legal proceedings to assess the likelihood of unfavorable rulings for ongoing litigations. With these 5 accounts, we also considered while planning this audit, the ongoing litigations are exposed to inherent uncertainties and unfavorable rulings could occur. An unfavorable ruling were to occur, it may cause material adverse impact on the results of operations, cash flows, or financial condition for the period in which the ruling occurs or future periods. The risks associated with the company's partnership with TD Bank Group, with the future legal issues arising from the data breach, and finally the new accounting standards update, which pertains to revenue from contracts with customers. With that said, this concludes our preliminary audit meeting. Please do not hesitate to reach out if you have any questions. Thank you.